Hi everyone, thanks for tuning into my channel, All Things Accounting. Today what we're going to be dealing with is compounding interest, and particularly the present value and future value of an annuity. So stay right there and we'll go through this together. So in my part one of part two, I was dealing with compounding interest with regards to present value and future value of a single amount. So in this particular tutorial, we're going to be dealing with what an annuity is, and we'll calculate a numerical example of what future value and present value of an annuity would be. So again, here we're dealing with, this is the third one, which will be future value of an annuity. And this is, then we'll be dealing with present value of an annuity. So for those who have never dealt with annuities, so an annuity, what it is basically it's a series of consistent payments that are made or received, usually sometimes at the end of the year, at the beginning of the year, but the key is that it's consistent amounts. And so in this case, let's say for example, if you receive $3,000 per year at the end of each year for the next 4 years, the interest rate is 10%, compounded annually. How much accumulated principal and interest will there be at the end of the 4 years? So just notice here, there's going to be at least, at the very minimum, $12,000, because again, each of the four, at the end of each of the next 4 years, there's $3,000 going to be received. So when we talk about compounding interest, at the end of year one, you'll be earning interest on $3,000, and year two, you'll be receiving another $3,000, but also you'll be accumulating interest on the $3,000 in year one, plus all of the interest that was accumulated on year one as well. So it's interest. Compound interest is interest being earned on the principal plus the interest that's been outstanding as well. So if we calculate the future value of this, we know that payment is $3,000, and in this case is the compounding period, which is 4 years because it's compounded annually. I is 10%. So if we were to apply a formula, that would be, in this case, that here. So payments would be $3,000 multiplied by 1 plus 0.1 to the 4 plus 1 all over 0.1. So if we compute that, that would give us $13,923. So at the end of 4 years, all of the principal payments or principal amounts that we receive, plus interest on the principal, plus interest on the interest, because it's compounded, would yield $13,923. So for our last example, we'll be dealing with the present value of an annuity. So a slightly different scenario from the last scenario. Let's say, for example, if you receive $4,000 per year for 4 years, with the first one being received 1 year from today. If the interest rate is 10% compounded annually, what amount would you need at the present time to have an amount equivalent to the series of payments and interest in the future? So in this case, we are calculating the present value. So present value, let's look over here. What are our given amounts? Our payment amounts are $4,000. Our N, or compounding periods, is 4 for 4 years compounded annually. Our I is equal to 0.10, 10%. So if we were to plug this into a formula, that would be equal to present value is equal to payments multiplied by multiplied by 1 minus 1 over 1 plus I to the compounding period all over I. Again, this is a factor. There's usually a table for compounding periods and interest that one can look up for quick reference. But if you were to compute all that, it would be $4,000 multiplied by the factor. In this case, it would be 3.17 if you calculate all that out here. So that's what it would yield. And that equals to $12,680. That's what you would need in the present value in order to have so that you can it would satisfy this problem here. So that's two different scenarios: future value of an annuity and present value of an annuity. I hope this tutorial helps. If you liked it, please subscribe to my channel and hit that bell notification icon so that you're always up to date on the new tutorials that I'll be holding, and hit that like button. So until next time, take care.